Imagine this. You're 25 years old. You've just started your career. Your salary looks exciting. Maybe 6 or 7 lakh a year. You feel independent. You feel like you're finally building your life. But then tax season arrives, and suddenly thousands of rupees are gone. Your Form 16 looks like a crime scene. You worked so hard, and yet a big chunk of your income just vanished. It feels unfair, doesn't it? Now here's the twist. What if I told you you could legally outsmart this system? Not by cheating, not by hiding, but by using the very laws that exist to help you. Because here's the truth. The government doesn't just collect taxes, it also gives you rewards. If you make smart financial moves. Today, I'm going to share 10 powerful strategies to save income tax in India. Every single one is 100% legal. Every single one could save you thousands, even lakhs. And the best part? These strategies aren't just about saving tax. They're about building wealth, creating financial freedom, giving yourself more choices in life. So if you're in your 20s or early 30s, buckle up. Because what you learn in the next 25 minutes might just change your relationship with money forever. And don't worry. I'm not your boring uncle who drones on about passbooks and receipts. I'll keep this sharp, smart, and maybe even fun. Ready? Let's dive into the first strategy. Point 1. Section 80C investments. Section 80C is the king of tax saving. If you're not using it, you're literally giving money away for free. Here's how it works. You can reduce your taxable income by up to 1.5 lakh rupees every single year. Now, where do you put this money? Options include Public Provident Fund, Employee Provident Fund, Equity-Linked Savings Schemes, 5-year tax-saving fixed deposits, National Savings Certificates, Sukanya Samriddhi Yojana, and even your life insurance premiums. Let's bring this to life. Say your annual income is 8 lakh rupees. Without deductions, under the old regime, you might pay around 65,000 rupees in tax. But if you invest 1.5 lakh rupees under Section 80C, your taxable income drops. Your tax bill shrinks by more than 30,000 rupees. That's like getting a bonus. Just for being smart. Now let's compare two friends, Arjun and Rahul. Both earn 8 lakh rupees. Arjun invests in ELSS funds. Rahul doesn't. At the end of the year, Arjun pays less tax and also has investments growing for his future. Rahul pays more tax and has nothing. Here's a common mistake. People dump money into insurance policies they don't need just to exhaust 80C. Don't do that. Choose wisely. If you're young, ELSS funds are fantastic. Short lock-in, potential for high returns, and tax savings. So remember, Section 80C is not just about cutting tax, it's about making your money work. Because every rupee you save today compounds into lakhs tomorrow. And this is only the first step. The real game begins when you stack this with other deductions. Point 2. Health insurance, Section 80D. Now let's talk about something most people ignore until it's too late. Health insurance. Let me ask you, what's scarier? Paying income tax or paying a 5 lakh hospital bill out of pocket? Here's the smart move. Buy health insurance. Because not only does it protect you during emergencies, it also reduces your taxes. Under Section 80D, you can claim up to 25,000 rupees every year for premiums. If you're also paying for your parents' insurance, you can claim another 25,000 rupees. And if they're senior citizens, that benefit jumps to 50,000 rupees. So, let's do the math. A young professional buying insurance for themselves and senior citizen parents could claim up to 75,000 rupees worth of deductions. That's big money. Here's where most young adults go wrong. They think, I'm healthy. Why waste money? But the reality is, one accident, one surgery, one emergency can wipe out years of savings. And by then, it's too late to buy insurance. Another mistake, buying only the cheapest policy without checking coverage. You might save a few hundred rupees on premiums, but lose lakhs when the policy doesn't cover your treatment. So the right move is simple. Buy health insurance early, lock in lower premiums, protect your future, and enjoy tax deductions every single year. So I'll ask you again, would you rather spend 20,000 rupees on insurance now, or pay 5 lakh rupees later with no tax benefit? The choice is obvious, and the best part? This deduction stacks beautifully with 80C. Together, they already save you over 2 lakh in taxable income. But what if you're planning something bigger, like buying a house? That's where the next strategy comes in. Point 3. Home loan benefits. Owning a home is a dream for many, but here's something people don't always realize. The tax system actually helps you make that dream affordable. If you take a home loan, you get 2 types of deductions. Under Section 24B, you can claim up to 2 lakh rupees every year on the interest you pay. And under 80 degrees Celsius, you can claim deductions on the principal repayment. Let's look at an example. Suppose your EMI is 30,000 rupees a month. That's 3.6 lakh rupees a year. Out of this, say 2 lakh rupees is interest and 1.6 lakh rupees is principal. Under the law, you can claim both. End result? Your taxable income drops massively. Your tax bill reduces by 70,000 rupees to 80,000 rupees every single year. Now think long term. Over 10 years, that's savings of 7 to 8 lakh rupees, just from the tax benefits. On top of that, you're building an asset, your home. But here's a warning. Don't rush into buying a house just to save tax. A bad loan or a house in the wrong location can trap you financially. Always buy when you're ready, not just for deductions. The lesson? A home loan is not just debt, it's also a shield against taxes if you use it wisely. But let's say you're not ready for a home yet. That's fine. There's another powerful tool to save taxes while building your future, and that's the National Pension System. Point 4. National Pension System, Section 80 CCD. The National Pension System, or NPS, is one of the smartest ways to prepare for retirement while also reducing taxes. Here's how it works. Under Section 80 CCD 1B, you can claim an additional 50,000 rupees deduction every year over and above the 1.5 lakh from 80C. That means your total deductions can reach 2 lakh rupees. So if you've already maxed out 80C and you're still looking for savings, NPS is the answer. Here's the beauty. NPS is flexible. You can choose between equity, corporate bonds, and government securities. The returns are market-linked, usually higher than fixed deposits, and the costs are super low. Now imagine this. You invest 5,000 rupees a month into NPS. That's 60,000 rupees a year. Over 20 years, even with modest returns of 10%, you could build a corpus of nearly 40 lakh rupees. And every year you also save taxes. The mistake many young people make is ignoring retirement. They think, why plan now? I'm only 25. But retirement planning isn't about age, it's about time. The earlier you start, the richer you retire. So think about it. Would you rather struggle at 60 or relax knowing your investments are taking care of you? NPS gives you that peace of mind while slashing your tax bill. But let's move from long-term retirement to something you might be dealing with right now: education loans. Point 5. Education loan interest, Section 80. If you or your parents have taken a loan for higher studies, here's good news. The interest you pay is fully deductible under Section 80E. Yes, you heard that right. No upper limit. This applies to loans taken for yourself, your spouse, or even your children. And it doesn't matter whether it's in India or abroad. Let's make this real. Suppose you're paying 1 lakh rupees in interest every year on an education loan. That entire 1 lakh rupees is deductible. If you're in the 20% tax bracket, that's 20,000 rupees saved each year. The benefit is available for up to 8 years, or until you finish paying interest, whichever is earlier. Here's a pro tip. Even if your parents took the loan for your education, they can claim the deduction, provided they're the ones repaying it. The mistake people make? They think an education loan is just a burden. But in reality, it's also a tool to reduce taxes. So if you're paying back an education loan, don't miss out on this deduction. It's literally free money. But let's say you don't have an education loan. Don't worry. There are still more ways to save. For example, have you ever donated to charity? Point 6. Donations, Section 80. G. Here's something interesting. Did you know that generosity can actually reduce your tax bill? Under Section 80G, donations to certain charitable institutions, relief funds, and NGOs are eligible for tax deductions. Depending on where you donate, you can claim either 50% or even 100% of the donation amount as a deduction. For example, if you donate 10,000 rupees to the Prime Minister's Relief Fund, the full amount can be deducted from your taxable income. That means you save taxes, while also making a positive difference. But here's the catch. Not every donation qualifies. You need to donate to institutions approved under Section 80G. Random contributions or cash donations above 2,000 rupees won't count. The government wants transparency, which is why online or check payments are encouraged. Here's a thought experiment. Imagine if instead of losing 10,000 rupees to tax, you redirected it to a cause you care about. Say education for underprivileged kids. You save on tax and you also feel good about where your money went. That's impact with benefits. The mistake many people make is donating casually without checking eligibility. Always ask for the 80G receipt and confirm the institution's approval. So next time you want to contribute, think strategically. Your kindness can also be a tax-saving weapon. And speaking of kindness, let's talk about something closer to home: your family. Point 7. Family expenses and allowances. Taxes don't just reduce through investments, they also reduce through smart structuring of your income. Let's start with house rent allowance, HRA. If you live in a rented home and receive HRA as part of your salary, you can claim deductions on the rent you pay. The calculation depends on your city, rent, and salary, but the savings can be substantial. Here's a story. Sneha, a 26-year-old software engineer in Bangalore, pays 20,000 rupees rent every month. By properly claiming HRA, she saves almost 30,000 rupees in taxes every year. Without it, she'd be losing that money unnecessarily. Then there's Leave Travel Allowance, or LTA. Twice in 4 years, you can claim deductions for travel expenses within India for you and your family. Flight, train, bus, all eligible. It's like the government saying, go take a holiday, and save tax while doing it. Other allowances, like meal vouchers, education allowance for children, and even phone bill reimbursements, can all reduce your taxable salary if structured correctly. The mistake people make? They ignore these perks or don't submit proofs to HR on time. That's literally money left on the table. So here's the pro tip. Don't just focus on investments. Optimize your salary package too. It's like playing cricket. You don't just score runs with boundaries, you also rotate the strike with singles. Small deductions add up to big savings, and if you think this is clever, wait until you hear about tax-free income sources. Point 8. Tax-free income sources. Not all income is taxed. Some income streams are completely tax-free, and if you learn to use them, you can save even more. For example, interest earned on your Provident Fund is tax-free within limits. The maturity amount from Public Provident Fund is also tax-free. Dividends from certain shares, under limits, can be tax-free. Then there's agricultural income. If your family owns farmland and you earn income from it, that income is exempt from tax. Of course, it has to be genuine agricultural activity, not just paper transactions. Even gifts, up to 50,000 rupees a year from non-relatives, are tax-free. And any amount received from relatives, like parents or siblings, is completely exempt, no matter the value. Here's a simple scenario. Suppose your parents gift you 2 lakh rupees to invest in your higher education. That money is not taxable in your hands. Compare that to earning the same amount as salary, where a big chunk would go in tax. The key here is awareness. Too many young professionals focus only on salary income and forget these exemptions. So here's the takeaway. Not all money you receive is taxable. Learn the difference between taxable and exempt income, and you'll instantly have an edge. But now comes the big question. With so many deductions and exemptions, which tax regime should you even choose? The old or the new? Point 9. Old regime versus new regime. This is one of the most confusing areas today. Should you stick with the old tax regime, full of deductions and exemptions, or switch to the new regime with lower tax rates but fewer deductions? Here's the breakdown. The new regime offers simpler slabs with lower rates, but you lose out on most deductions like 80C, HRA, and 80D. It's straightforward, no calculations, no proofs. The old regime, on the other hand, allows you to claim all the deductions we've been talking about: 80C, 80D, 24B, 80E, and more. But the slabs are slightly higher. So which one is better? It depends. If you're someone who invests actively, pays insurance premiums, has a home loan, or takes advantage of HRA, the old regime will almost always save you more. If you're just starting out, have no major deductions, and don't want the hassle of paperwork, the new regime might be simpler. Here's a quick example. Rohan earns 10 lakh rupees a year. Under the old regime, with ADC, ADD, and HRA claims, his tax comes down to around 65,000 rupees. Under the new regime, he'd pay around 75,000 rupees. For him, the old regime is clearly better. The golden rule is, calculate both every year. The government actually allows you to choose each financial year. That means you can switch depending on your situation. So don't blindly follow what your friends or colleagues do. Run the numbers, be strategic. And finally, let's end with the ultimate tip. Point 10. Advanced planning and avoiding mistakes. You've heard all the strategies, but here's the truth. None of them will work if you only wake up in March. That's the biggest mistake young professionals make. They scramble in the last week of March, invest blindly, and then regret later. Tax saving is not a one-night affair. It's a year-round strategy. You need to plan your investments in April, not March. Here's the mindset shift. Don't see tax saving as a burden. See it as an opportunity to build wealth. Because the money you invest to save tax doesn't just reduce your liability, it grows, it compounds, it creates your future. So here are 3 golden rules. Number 1. Start early, spread your investments across the year. It's easier on your pocket and smarter for returns. Number 2, don't chase deductions blindly. Choose options that align with your goals, whether it's ELSS for wealth creation, NPS for retirement, or insurance for protection. Number 3, always keep documents and proofs ready. Nothing hurts more than losing deductions just because you missed paperwork. And here's a bonus, stay updated. Tax laws change every year in the budget. A smart taxpayer keeps learning and adapting. So ask yourself, do you want to be the person who panics every March? Or the one who confidently builds wealth while paying minimal tax? The choice is yours. Let's recap. You've learned 10 powerful ways to save income tax legally in India. From Section 80C investments to health insurance, from home loans to education loans, from donations to allowances, from exemptions to regime choices, and finally, the mindset of planning early. Remember, saving tax is not about avoiding responsibility. It's about using the law to your advantage. The government wants you to invest, to insure, to buy a home, to support your family, and to give back to society. That's why these benefits exist. So the next time tax season comes around, don't panic, don't complain. Smile because you know the secrets most people ignore. And if you take just one thing from this video, let it be this. Tax planning is life planning. The earlier you master it, the freer and wealthier your future becomes. Now it's your turn. Which of these strategies will you start using this year? Drop your answer in the comments. I'd love to know. And if this video helped you, share it with a friend. Because financial wisdom is the best gift you can give. Until next time, keep saving, keep investing, and keep building the life you deserve.